Here's a question for you. When a recession hits, why is it that car companies seem to face massive layoffs while the folks making toothpaste barely even flinch? Well, the answer isn't just random luck. It's actually built into a hidden structure in the market, a kind of secret map. And understanding that map, well, that's the key to smarter analysis. I mean, let's be real. Staring at the stock market can be totally overwhelming. It's like looking up at the night sky, just a galaxy of thousands and thousands of stars. You've got your tech giants, car companies, banks, drug makers. Where do you even begin to make sense of all that? You start with that map. See, instead of getting lost in thousands of individual disconnected companies, this map groups them all together. It reveals a clear structure and shows you exactly how everything connects to the bigger picture, the economy. So, what is this map? Well, it's a really powerful classification system that all the pros use to navigate the market with, some actual precision. It's called GICS, the Global Industry Classification Standard. I know. The name sounds super complicated, but the idea behind it is incredibly simple. It just organizes every single company based on one fundamental question. Where does most of your money come from? What are you selling and who's buying it? That's it. Think of the map like a giant pyramid. At the very top, you have 11 broad sectors, things like information technology or healthcare. And as you go down, it gets more and more specific, breaking down into industry groups, then industries, and all the way down to super specific sub-industries. This whole structure is what lets you make real, true apples-to-apples comparisons. And here's where this map gets really powerful. The biggest, most important insight it gives you is how it splits the entire economy into two fundamental kinds of businesses. The ones that thrive in a boom and the ones that just survive in a bust. So on one side, you have your defensive sectors. These are the companies selling things we all need, no matter what the economy is doing. Toothpaste, electricity, medicine. Demand is pretty stable. But then, on the other side, you have the cyclical sectors. They sell the stuff we want when times are good. A new car, a fancy vacation, the materials to build new stuff. Their fortunes swing up and down, right along with the business cycle. But what's the reason for that? Why are those cyclical companies so much more volatile? Well, it all comes down to a powerful financial concept that acts like a profit amplifier. It's called operating leverage. Now, all that really means is how much of a company's costs are fixed. Think about a giant factory or expensive equipment. You have to pay for that stuff no matter how many products you sell. High fixed costs mean high operating leverage, and that magnifies everything. It just explodes profits on the way up and crushes them on the way down. Let me show you how this works with a quick example. Okay, so let's imagine two companies. We've got Staples Co., which has really low fixed costs, say 200 euros. And then there's Industrial Co., with its huge factory, so it has much higher fixed costs. Let's call it 800. To start, they're both making the same amount of money. All right, now let's say the economy starts doing a little better. And boom, both companies see their revenue grow by the exact same 5%. A nice, modest, and totally identical increase in sales for both of them. But, and this is the aha moment, look at what happens to their profits. Staples Co.'s profit grew by a pretty solid 5.6%, but Industrial Co.? Whoa, its profit shot up by 8.3%. That massive difference from the exact same revenue growth, that is operating leverage in action. It is the engine that drives cyclicality. So the huge takeaway here is that since these sectors have totally different financial engines, you just can't analyze them with the same tools. It doesn't work. If you try, you're going to get numbers that are not just wrong, but dangerously misleading. And this brings us to one of the biggest myths out there, the idea that a lower price-to-earnings ratio always means a stock is a better deal. That is just plain wrong. For cyclical stocks, a low PE can actually be a huge red flag, a warning sign that profits have peaked and are about to take a nosedive. You have to use the right tool for the right job. For a bank, a company in the financial sector, its business is its balance sheet. So the price-to-book ratio, which compares its price to its net assets, is absolutely essential. For those big, capital-heavy industrials, a metric like EV to EBITDA is way better because it gives you a much cleaner picture of the company's value without getting distorted by things like debt. Okay, so how do you actually put all this into practice? It's easy. You just make one small change. Make classification your very first step, every single time. It's a really simple three-step approach. 1. classify the company. Find it on the map. 2, identify its profile. Is it a cyclical business or a defensive one? And 3, pick the right analytical lens for that specific part of the map. This little framework gives you the context you need to stop guessing and start navigating the market with real confidence. At the end of the day, analysis without context is just noise. The sector and the industry provide that all-important context. So now you have the map to the market's hidden structure. The only question left is, where are you going to look first?